You've probably heard of saving in one form or another. But why is it important, and is there a right way to do it? Hi, I'm Jasmine. Welcome to part 3 of my personal finance starter pack, savings. The topics I'll cover include why it's important to save, why it's important to have a savings account, what they are, and different types of savings accounts. At the end, I'll give a few suggestions for next steps. Now, why is it important to save? First off, it helps you prepare for emergencies. This is what people call your emergency savings or your emergency fund. The amount you keep in your emergency fund is usually 3 to 6 months of necessary spending. You want to keep it in a savings account because it's more liquid, and so you can take it out whenever you want in case something bad happens. So it has to be accessible for you to use it. I usually keep $500 of my emergency savings in a savings account that is tied to my bank account or checking account. This is in case I need cash in like the next 10 minutes since the transfer time is so quick. And then I keep the rest of my emergency savings in a high yield savings account. I think this is the best option for me since it's not bound by a CD in terms of time period, and stocks are a little bit too volatile for an emergency fund. The second reason saving is important is to avoid debt. During turbulent times, your savings can help you avoid debt. Instead of using high interest credit cards or taking out a personal loan, you can use your savings to keep yourself afloat. Saving can also help you reduce your financial stress and also improve your financial security, because you know that no matter what happens, you have money to spend on things that you need. There are many other reasons why saving is good for you, but the last one I'm going to talk about is it helps you pay for large purchases. Is there a really long trip you want to make before you have to go back into the office? Well, saving can really help you out with that. Instead of paying for it with your credit card, unless you're using credit card points, you can begin saving now, and then when your trip comes, you'll have enough money to spend without feeling sad. Short to medium term goals are best put in some form of a savings account and not in the market. And that's anything with a 5 to 10 year horizon. And I say 10 years because usually a market has a cycle every 10 years. And you don't really want to be putting a short or medium term goal in the market because one dip in the stock market could wipe out half of your vacation fund. And generally, 3 to 5 years is not enough for your investment portfolio to come back from a downturn. That means you'd have to potentially kiss your trip to Europe goodbye. Why is it important to keep a savings account? Number 1, it keeps your money safe, and so you can protect your assets. Savings accounts are considered much more safe than investments, since the money won't get wiped out by stocks. And savings accounts typically have insurance on them, so no matter what happens at the end of the day, the money is still there. Having a separate savings account can also reduce your temptation to spend. For me, putting money in a separate savings account has made it just that much harder for me to take that money out of my savings account and back into my checking account, so it actually deters me from spending that money. If spending is what's causing you to not save as much, make sure to check out my budgeting video. Having a separate savings account can also improve your financial organization. Having separate savings accounts can really help in categorizing your savings. Each savings account could be for a different goal that you're saving up for. A savings account is also amazing for maintaining liquidity. In the event of an emergency, you want to have cash on hand. And you don't want to wait 5 days for your stocks to be sold and also for the money to go back into your checking account. This is why savings accounts are much more feasible for an emergency. If you need money ASAP, a savings account allows you to just have it, so you don't have to starve for multiple days just to wait for your money to come in. Not to mention, some of these investment accounts have limitations on what you can spend it on or how much you can take out. I'm looking at those tax-advantaged accounts, like HYSAs, your Roth IRA, and traditional IRAs, among many other things. Moving on to the background of some money principles. The first one is the time value of money. Basically, time value of money means that the same $100 today is worth more than $100 in the future because of its earning potential or potential earning capacity. The next money principle is compounding interest. Interest can be used to make more interest, since every time you earn interest, it can be counted towards your principal. At year 0, you put in $100, and at year 1, you make 1% interest, so $1. So your total now in your bank account is $101. With compounding interest, now you make 1% of $101 versus 1% of the original $100. So 1% of $101 is $1.01. At year 2, you would have made $102.01 versus $102 if you didn't factor in compounding interest. Yes. Since we know why savings accounts are good, what are they? A savings account is an interest-bearing deposit account held at either a bank or another financial institution. There's a federal law that makes sure that you can only withdraw from your savings account at most 6 times a month. Withdraw being transfers and withdrawals. Now I'm going to go through the business of a savings account, so how banks make money out of your savings account. If you're not interested in that, feel free to skip to the next chapter. Banks use your money to make more money. They use the money that you have deposited to loan to other people, but the bank loans it out at the cost of the lendee or the person who gets the loan. So think things like mortgage, student loans, credit card loans, etc. But when you deposit money into your savings account, you're basically giving permission to your bank to use that money to make loans and be able to give you interest. Generally, the interest rate they get from loaning out the money is higher than the interest rate you get back from them. So they take a small cut of that percentage. One term you'll see pop up multiple times in terms of savings accounts is the APY. And APY stands for annual percentage yield. This indicates the total amount of interest you will earn over a course of a year if you do not withdraw or deposit any more funds into your savings account. The value of APY includes your interest rate and also the frequency of your compounding interest, monthly, semi-annually, annually, etc. And as we spoke about before, compounding interest is basically where your interest folds into part of your principal the next month, and then that interest creates more interest in return. Say you have $5,000 at a bank that pays 1% interest annually. This is also equivalent to your interest compounding annually. That means over the course of the year, if you don't add money or withdraw money from your bank account, you'll earn $50 after the first year. Now, interest doesn't usually get paid out annually. In fact, most of the time it's paid out on a monthly basis. I know it doesn't sound like a lot, but the main purpose of a savings account is to make sure that you have enough money to live off of, and if anything comes up, that money is always there and doesn't fluctuate the way that a stock market would. But it's also super important to invest and also to have a diverse portfolio. But given that we want to be as low risk here as we can, it makes a lot of sense to keep your savings in a place where the risk is very low, but the return may also not be as high. A little bit of big picture on things that affect the interest rate. The first one is the Fed, or the US Central Bank. Their two main goals are full employment and also keeping prices stable, so no inflation. And inflation is just rising prices over time. And so you might be wondering how the Fed actually achieves these two goals. They do this by creating policies that either increase or decrease the money supply, mainly through changing the interest rates. With lower interest rates, that means that saving isn't as attractive to consumers and also businesses. But on the flip side, it makes borrowing money a lot more attractive. For businesses, they can borrow money to either create new jobs or also invest their money. While for consumers, When savings is not as attractive as other options, borrowing money to spend on the economy is more attractive. Another note for lower interest rates, it means that mortgage rates are also lower since it is cheaper to borrow money. During this past year, when interest rates were super low, there was a lot of talk about refinancing your home to get a lower interest rate, and so you'll end up paying less interest back to the bank at the end of your 30-year mortgage. The second element that affects the interest rate is basically the supply and demand of money. This one is, I think, a little bit less decisive as the other one. I have a small scale example. If the demand for money is greater than the supply of deposits at a bank, like the amount of savings that people have, to remedy this situation, banks either have to borrow money from other banks, raise capital, or increase rate to pay depositors for more people to deposit money. And that rate is your savings account rate. If you go onto their website and you look at the disclaimers at the bottom, they'll usually always mention that they are FDIC insured. So I talked a little bit earlier about how having a savings account kind of protects your assets because there's insurance on your savings. And this is where FDIC insured comes in. FDIC is an independent agency of the US government. They protect you from losing all of your assets if the Savings Association or the FDI insured bank fails. FDIC insurance is backed by the US government, basically. There are so many different types of savings accounts. Some that I've already mentioned include regular or traditional savings accounts, high yield savings accounts, certificate of deposits, and yeah, I think that's it. That's all I've said so far. While there are several types of savings accounts, the most popular ones are traditional savings account, certificate of deposit, and the money market account. A regular savings account is one that you'll probably get with your bank. They offer very low interest, like 0.01% APY or something. This is a good option if you already have a checkings account with this bank and there's no delay between transfers. So if you have any emergency that you need cash for, this is your go-to. And it's much faster than other options. High yield savings account. This one is kind of like what the name is. It's a savings account, but with a much higher APY. A lot of high yield savings accounts started as online banks, so they saved a lot of money from not having brick and mortar stores. Some high yield savings accounts that are a little bit better in terms of interest rate include Amex's savings account, Ally Bank, which is an online bank, a few robo-advisors like Wealthfront and Betterment, and also Marcus by Goldman Sachs. Some credit unions also offer higher savings rate and lower interest rate for loans, since they're not focused on making a profit, but more focused on covering their own operating expenses. Because of this difference in their priorities in comparison to traditional banks, they are able to offer better rates for their members. Next up, we have a money market account, which is generally offered at traditional banks and also credit unions as well. I'll put the advantages and disadvantages up here. But basically, a money market account requires you to have a minimum deposit amount and also maintain that minimum deposit amount throughout the course of you having that account. And many will impose fees if your balance falls below the minimum they require. Next, we have a certificate of deposit, which its acronym is a CD. So a CD generally has a timeline of either like 6 months or 12 months or 18 months, depending on the type of CD you have. have. But this type of account, when it has a time frame, it restricts you from taking money out or putting money in. A CD generally has a higher interest rate in comparison to a normal high yield savings account or a bank offered savings account. The next one is a cash management account, which is basically an account that's held at a financial institution that allows you to manage your cash transactions in one portal. Another great feature you can find with a cash management account or a CMA is that it has a higher interest rate. And this interest rate is calculated daily and paid out monthly. And again, the pros and cons are up here. So this cash management account combines features of checkings, savings, and or investment accounts, all under one product. So I've mentioned more of the conventional savings accounts, and now it's time for the unconventional ones, or one, I guess. So BlockFi has an interest account. Theoretically, they are doing the exact same thing with your assets in your interest account. But instead of having money in there, you're actually holding Bitcoin. Their interest rate is based off of 1 Bitcoin versus the actual dollar amount of a Bitcoin. When you earn interest there, they'll actually be giving you Bitcoin versus actual money. So what happens when BlockFi has your 1 Bitcoin? They basically take that 1 Bitcoin and lend it to trusted institutions and corporate borrowers. Let's say February 28th, 2019, you deposited 1 Bitcoin. After 1 year in the BlockFi interest account, you would have made 6.2% on that Bitcoin. So you would have 1.062 of a Bitcoin by February 28th, 2020. And that 6.2% is only on that Bitcoin. So if your Bitcoin increases in price, then obviously your 6.2% will be higher in value. But the opposite effect also happens. If Bitcoin goes down in value, your 6.2% will be worth less than a normal 6.2%. Does that make sense? So this is a very interesting concept, but for savings, it might be a little bit too risky for what you might want to do. And it may not be the safest choice, especially if you know you'll need that money within 10 years. And I say it's a little bit too risky for savings because Bitcoin fluctuates in price. So you might think, oh, I'll use this for investments instead. But 6.2% on 1 Bitcoin actually underperforms the S&P. The S&P actually returned 30% in 2019, and in 2020 it returned around 16%. As I mentioned before, it's really important to have a diverse portfolio, so your portfolio should include a little bit of diversity in the form of Bitcoin and also stocks and investments and stuff like that, and also cash and real estate if that is possible in your budget. But yeah, diversity is the clear winner here. With all this new information, you're probably wondering what the next steps are. Number 1, with your emergency savings, you want to figure out what type of account you want to hold it in. My recommendation is to have a savings account with a bank that you have a checkings account with, and only putting 1 week of like living expenses in there. And the rest I would put in a high yield savings account, even though they're not super high yield right now, but they protect you in terms of like needing the money ASAP or like not getting a huge tax bill because you liquidated your stocks. So the next thing I would think about is your short, medium, and long-term goals. For short term, that would be anything from now to a year and a half. So like a long trip that you're planning in the next 3 months would be a great short-term goal. I would say the best bet for this type of savings is to put it in a high-yield savings account. Generally, the shorter the time span, the less I'm willing to risk. So having it in a high-yield savings account is the safest bet and I think the best choice here. I also wouldn't really put it in my traditional savings account because it's a little bit easier for me to access that money, and so I would end up spending it. And also high yield savings account, even though it's $1 or $2 of interest per month, it at least gets you something more than just like having your money sit in a bank. Now, a medium-term goal, I would consider anything from 1.5 years to 5-year time horizon. Here you could look into a CD if you know you're not going to end up touching that money for another 1.5 years to 5 years. These goals could be things like buying a home or like getting married. An interesting tidbit I have for you is that an average wedding in New York City costs $66,000. Don't skimp on your wedding. So make sure you save up for your wedding so you are not put into debt for the rest of your life. Now, 5 to 10 years is long term, but it's not at a business cycle yet, and so it's kind of like an awkward link. And here, choosing an account really depends on your risk tolerance. Lower risk obviously would be something like a high yield savings account, as I was talking about before. So anything higher risk could be things such as BlockFi's interest account. Purchasing bonds is a little bit less risky, and then it goes to like ETFs, mutual funds, and then like stock market stocks, and maybe even blockchain. I'm not sure if you all plan that far ahead, and even if it feels like it's too far in advance, I know that I can always repurpose the money for something else. So it doesn't really feel like a loss to me at all, even if I don't end up doing the things that I planned for. Does that make sense? I hope this was helpful, and bye-bye!